University of Buckingham, Money, Banking and Financial Markets, Summer Term 2020. Lecture 5, The Financial Structure of Modern Economies. Before we start, just a quick slide to say that despite online teaching, the student experience is still here for you. And here's a slide with information on the Students' Union, Career Service, Students First and Student Conduct. Contents of Lecture 5, reference to Michigan chapters 2, 7 and 8. We're going to look at the financial system, briefly concentrating on the United States. Brief introduction to the structure of financial markets, then an extremely brief look at equity markets, of course, which is an enormous subject. First, we'll look at an overview of the financial system, concentrating on the United States, but obviously it would be interesting if you compare it with the country that you're familiar with, to compare the same structures. Learning objectives: to compare and contrast direct and indirect finance, identify the structure and components of financial markets, list and describe the different types of financial market instruments, summarize the roles of transaction costs, risk sharing and information costs as they relate to financial intermediaries, list and describe the different types of financial intermediaries, and identify the reasons for and list the types of financial market regulations. Well, what are the functions of financial markets? Financial markets performs the essential function of channeling funds from economic players, savings in other words, that save surplus funds, to those who have a shortage of funds. In direct finance, borrowers borrow funds directly from lenders in financial markets by selling them securities. Let's look at the flow of funds through the financial system. Flow of funds can either come from indirect finance, through financial intermediaries, and the funds then go to financial markets, or through direct finance into financial markets. And we have lenders, savers, households, business firms, government and the foreign sector, and obviously borrowers and spenders are also business firms, government, households and the foreign sector. Here's some view of size. In 2016, amounted in billions of dollars a year. The federal funds and security repurchase market has grown enormously. 3.8 trillion in 2016 from 372 billion in 1990. Commercial paper increased and has gone down. Negotiable bank certificates of deposit in large denominations has increased, and US Treasury bills of the second largest money market instrument. So, what are they composed of? Well, money market instruments, US Treasury bills, no interest payments, but they're sold at a discounted price, which as we receive can give a yield to maturity. Most liquid instruments. We also have negotiable bank certificates of deposit, commercial paper, repurchase agreements with very short maturities, treasury bills serve as collateral, an asset that the lender will receive if the borrower defaults, and federal funds. Capital market instruments. Here let's look at the principal ones. Again, growth from 1990 to 2016. in the United States, corporate stocks would be the largest market, 38 trillion. Corporate bonds, 12 trillion. US government securities, long term, 12 trillion. US government agency securities, 8.5 trillion. State and local government bonds, bank commercial loans, consumer loans, commercial form mortgages, and residential mortgages. All these are capital market instruments for where borrowers can actually receive funds for longer term. Well, financial markets have become increasingly internationalized. Foreign bonds are sold in a foreign country and denominated in that country's currency. A Eurobond, a bond denominated in the currency other than that of the country in which it is sold. Euro currencies, foreign currencies deposited in banks outside the home country. Euro dollars, US dollars deposited in foreign banks outside the United States or in foreign branches of US banks. And then, of course, there's the American corporations and other corporations not outside America can have access to world stock markets, which help finance corporations in the United States and also do help fund the US federal government through holdings of US government securities. Well, what type of efficiency gains can financial intermediaries help with? Well, they deal with asymmetric information problems. The fact that one party to a transaction has got different information to another one. So, adverse selection, for example, before the transaction. Try to avoid selecting a risky borrower by gathering information about them. Again, borrowers know more about their own credit risk than the company lending the money. So a financial intermediary can acquire information about borrowers and grade them and so on. Moral hazard after the transaction: ensure that the borrower will not engage in activities that will prevent him or her repaying the loan. So again, sign contracts for restrictive covenants. In other words, make sure that they don't change their behaviour after a loan has been agreed. So the conclusion: financial intermediaries allow small savers and borrowers to benefit from the existence of financial markets. Types of financial intermediaries. Here we just have, for look at your leisure, in the United States, type of intermediary: depository institutions, banks, commercial banks, savings and loan, mutual savings banks, credit unions. The primary liabilities, source of funds, and the primary assets, uses of funds. So commercial banks, of course, make business and consumer loans, mortgages, purchase US government securities and municipal bonds. Savings and Loans Association deals specifically, generally, with mortgages. Contractual savings institutions, life insurance companies, fire and other casualty insurance, pension funds, retirement funds, and so on. The primary liabilities, sources of funds, are primary premiums from the policies or contributions by employers or employees, and the primary assets an insurance company would be tend to buy corporate bonds and mortgages. And here's some more: finance companies, mutual funds, money market mutual funds, hedge funds, again showing primary liabilities and primary assets. Here's some of the primary financial intermediaries and the value of their assets, again from 1990 to 2016. The value of the assets for commercial banks, the largest credit unions, Life insurance companies, pension funds very large at 9 trillion. State and local government retirement funds at 6 trillion. Life insurance companies, assets under management just under 7 trillion. A bit more, finance companies, mutual funds, money market mutual funds with some of their assets. Mutual funds very large, investing in primarily stocks, and nearly 14 trillion in assets. Let's look at the regulation of the financial system. We've said there are problems of moral hazard, adverse selection, and of course even fraud. But one of the important aspects of regulation of the financial system is to increase the information available to investors, to reduce the adverse selection and moral hazard problem, and to reduce insider trading, which is an asymmetric information problem, which the SEC is involved in. Ensuring the soundness of the financial intermediaries, restrictions on entry conditions, disclosure of information, which financial intermediaries have to do, restrictions on the assets and activities, controlling holding the risky assets, obviously deposit insurance to avoid bank runs, several views about that, and in the past limits on competition, but these limits have actually been increasingly deregulated. What are the main regulatory agencies of the financial system in the United States? The SEC, which looks at organised exchanges and financial markets. Commodities Futures Trading Commission, futures markets. Control of the currency, chartered commercial banks and thrift institutions. National Credit Union Administration. State Bank and Insurance Commissions, Federal Deposit Insurance Corporation, which provides insurance for up to $250,000 for each depositor of a bank, and looks obviously at the books and financial solvency of banks. And of course the Federal Reserve System itself, which looks at all depository institutions. Let's look at the structure of financial markets. Structure of financial markets, we have debt and equity markets. Debt instruments held to maturity. Equities are potentially infinite life, paying dividends. Debt instruments paying the coupons for coupon bonds. Derivatives, and they are primary and secondary markets. Investment banks, as we said, underwrite securities. Brokers and dealers work in secondary markets. There are exchanges and over-the-counter markets. Exchanges, the New York Stock Exchange, Chicago Board of Trade. Over-the-counter markets, foreign exchange, federal fund derivatives. Money markets deal in short-term debt instruments, and capital markets deal in longer-term debt and equity instruments. We're going to now look in a little bit more depth in equity markets. Stock markets. We examine markets where stocks trade and then review the underlying theories for stock valuation. We learn that stock valuation is quite difficult, and the topics we'll look at are investing in stocks, computing the price of a common stock, an ordinary share, listed ordinary share, how the market sets security prices, and errors in valuation. We will look at stock market indices, buying foreign stocks, and the regulation of the stock market. Well, investing in a stock is very different from investing in a bond. Investing in a bond is effectively the company is borrowing money and will repay it back in a particular period with some fixed coupon rates paid. Investing in stocks is different. It's actually represents ownership, an ownership share in a firm. You can earn a return from investing in stocks in two ways. The price of the stock can rise over time, of course it can fall, and dividends are paid to the shareholder or stockholder. The stockholders have claim on all the assets of the company. Generally, the right to vote for directors on certain issues. Two main types of stock, basically. Common stock has a right to vote and right to receive dividend. Preferred stock receives a fixed dividend, usually before other dividends are paid, but owners of preferred stock do not usually have a right to vote. How stocks are sold? Well, in organised exchanges. The New York Stock Exchange is one of the best known, like the London Stock Exchange, with a daily volume around 4 billion shares. Up, of course, there are some peaks. It's organised. It has a particular trading location, although computer systems have replaced the idea that there was a floor. Others include the ASE, the Nikkei, the London Stock Exchange, DAX, and the German Stock Exchange. Listing requirements tend to exclude the ability of small firms to list, and again, it's worth looking at in more detail if you're interested. There are also over-the-counter markets. Best example is Nasdaq. Dealers stand ready to make a market in the shares, and today there's somewhere over 3,000 different securities listed on Nasdaq. An important market for thinly traded securities that don't trade very often. Without a dealer ready to make a market, the equity would be difficult to trade, and the prices quoted eventually would vary quite significantly. Well, what's the difference between over-the-counter and organised? Organised exchanges tend to have auction markets with floor specialists. 25% of trades are filled directly by specialists. Remaining trades are filled through systems like SuperDot. Over-the-counter markets like Nasdaq, there are multiple market makers set to have bid and ask prices, and multiple dealers for any given security. Electronic communication networks allow brokers and traders to trade without the need of the middleman. They provide transparency. Everyone can see unfulfilled orders. They reduce costs, smaller spreads, faster execution, and they allow after-hours trading. There are problems with ECNs though. They don't work as well with thinly traded stocks, leading to quite volatile prices. Many ECNs competing for volume, which can be confusing, and most of the major exchanges are fighting ECNs with an uncertain outcome. Exchange traded funds are a fairly recent innovation to help keep transactions down while offering diversification in the portfolio. An ETF represents a basket of securities traded on a major exchange and indexed to a specific portfolio, for example the Standard & Poor's 500. Some management fees are low, although commissions still apply. The exact content of the basket is known, so the valuation of the ETF is. Well, how do you compute the price of a common stock? Valuing common stock is in theory no different from valuing debt securities. You look at the cash flows and discount them to the present value at an appropriate discount rate. Remember when we looked at bonds, we look at the coupon payments and then the final face value payments when bond reaches maturity, and we use a discount rate to discount that back given the present value. Or we have a price of a bond. We will look at future payments and the final term payment and work out a term to maturity, an internal rate of return in a sense. We'll look at 4 different methods which exist for valuing stocks. Each has different advantages and drawbacks. The one period valuation model, basic principle of finance. The value of any investment is the present value of future cash flows. So we could take a very, very simple case. We take the present value using the expected dividend and price over the following year. So the price of a stock will be the dividend received in the year plus the price expected at the end of the year, discounted by some discount rate. What is the price of a stock with an expected dividend price next year of 0.16 cents and $60? If you use a 12% discount rate, you would then get a theoretical price of $53.71. As the future extends, the price in the distant future will have a present value which is close to zero, say about 10 years out. And we don't know the entire stream of dividends, so the valuation of a stock as opposed to a bond becomes a problem of uncertainty. And one approach to this problem, which has been around for a long time, is called the golden growth model. What you do is the price is the dividend in year one, discounted at the rate for year one, dividend year two, discounted rate for year two squared, up until the dividend for year n, again discounted at the rate expected, to the power of n plus whatever the price is going to be in year n, and of course this is going to be pretty close to zero in terms of the present value. Or simplifying it, the price is going to be from t1 to infinity, the dividend expected in year t, discounted by the equity rate of discount at year t. We don't know the entire stream of these income of dividends. It's a question of uncertainty. They're going to go up and down. A simple approach to this problem is what's called the golden growth model. Same as the previous model, but it assumes that dividends will grow at a constant rate g. That is, the dividend in t plus 1 will be the dividend in t multiplied by 1 plus this constant growth rate. So the price is going to be the sum of from year 1 to infinity, the dividend in year t discounted by the rate of discount in year t, which is going to be rearranged as the dividend in year 1 divided by the discount rate minus the growth rate expected. As long as the growth rate is assumed at some constant level. The model is useful, but has certain simplifying assumptions. Generally, dividends do tend to grow at a constant rate forever, which of course they don't in real life. And the growth rate of dividends G is less than the required return on the equity, the discount rate KE. We need some estimate therefore of long-term growth of dividends G, which is very difficult. One simplistic approach is just simply use the average compound annual growth rate over a fairly long period of time. In other words, the growth rate is just simply the compound rate of growth. The average growth rate dt minus 1 to the root n, and this is just in a sense a geometric mean. Let's take a stock like Coca-Cola. Assume that dividends will grow at a constant rate of G, say 10.95%. Dividend is $1. The rate of return expected, the discounted rate, is 13%. And again, this is another question what you use for the discount rate. But this would give you a price using the golden growth model of $54. Another way of using the constant growth model of stock prices is to decompose the required return on equity into its component parts. So there's two parts to this effectively. The price now is going to be the dividend and its growth, and the required return on equity KE, the discount rate, minus the growth rate. And this would give you, by rearranging, you can calculate the return on equity you require is going to be the dividend in the following year divided by the price now plus the rate of growth. So the required return on equity is then equal to the dividend yield plus the capital yield. Dividend yield dt plus 1 over pt. plus the capital yield, which is the expected growth rate. Dividend yield is the amount paid to shareholders as a percentage of the firm's current stock price. Rather like a bond, there's the coupon yield, which is the yield paid, which of course is certain, divided by the bond price. The capital yield is the yield a stockholder receives due to an increase in the stock price in the future, or due to an internal investment to retain earnings, which allows the company to grow and dividends to grow. One way to look at this required return equation is to use it to calculate an expected return based on expected growth in dividends, earnings, or sales, for example. Another method used more in my time as a stockbroker, we use this a lot, is the price earnings ratio. It's a widely watched measure of how much the market is willing to pay for a dollar of earnings from firms. And the price earnings ratio is just simply price divided by earnings per share multiplied by earnings per share. Here's the some data on the price earnings ratio. It gives ideas of over and undervaluation. So this is looking at a long-term assumption. I think this is from the Shiller model, Case-Shiller model. You see a long-term price earnings ratio expected in the market of around about 17%, and you can see periods when this was over or undervalued. And you see the before the Wall Street crash in the 60s, and in the run-up to the first the internet boom and then the Great Financial Crisis. It's not a short-term tool. This is again showing the price earnings ratio for January every year and the subsequent annualized 10-year return to look at the relationship between the 10-year return and the price earnings ratio in that particular month. Given that this is how you theoretically try to evaluate the value of a shares, how does the market set security prices? Well, generally prices are set in competitive markets by the supply and demand for stocks. As the price set by the buyer willing to pay for the stock, who willing to pay the most for a share. The buyer willing to pay the most for an asset, a financial asset, is usually the buyer who can make the best use of the asset. And of course, superior information can play an important role in determining the demand for an asset. So, market price is set by a buyer willing to pay the highest price for a share. And better information can obviously increase the market value of an asset by reducing the perceived risk, in other words, the volatility. It's also highly possible that the person willing to pay the highest price is simply the one with an incorrect perception of risk and then will make a loss. Stock market indexes are frequently used to monitor the behavior of a group of stocks and also to compare the performance of an individual share or a smaller portfolio against the market. Major US indexes include the Dow Jones Industrial Average, the Standard & Poor's 500, the Nasdaq Composite, and the Wilshire 5000. Next two slides show the Dow Jones Industrial Average from 1980 to 2010. As it shows, $1 invested in the Dow Jones back in 1980, when it was around 800, would have grown to about $12.50 in 2010, when the Dow reached 10,000. This represents an annual growth rate of around 8.8%. Here we have the Dow Jones over that period. And another on the Dow Jones. And here's just some dates for different time periods, showing gains and losses in particular period. October 1987, a 23% loss. Regulation of the stock market. The prime mission of the SEC, the Securities and Exchange Commission, is to protect investors and maintain the integrity of the securities market. The SEC brings around 500 actions against individuals and firms each year to try and maintain this. This is accomplished through the joint efforts of 4 divisions: the Division of Corporate Finance, the Division of Market Regulation, the Division of Investment Management, and the Division of Enforcement. How are expectations involved in the stock market? Well, expectations are formed from past experience only. Changes in expectations will occur slowly over time as data changes. However, people use more than just past data to form their expectations, and sometimes change their expectations more quickly than theories of adaptive expectations would expect. Rational expectations will be identical to the optimal forecast using all available information in the market. Even though a rational expectation equals the optimal forecast using all information, it still may not be accurate. It takes too much effort to make the expectation the best guess possible, and the best guess will not be accurate because the predictor is unaware of some relevant information which isn't available to everybody. Implications: if there's a change in the way a variable moves, the way in which expectations of the variable are formed will change as well. Changes in monetary policy, for example. The forecast errors of expectations will on average be 0 and can't be predicted ahead of time. This leads to the efficient market hypothesis, which has often been used to explain the behaviour of stock markets. So current prices in the financial market will be set so that the optimal forecast of a securities return using all available information equals the securities equilibrium return. So in an efficient market, a securities price fully reflects all available information. What's the evidence? Favourable evidence: stock prices reflect publicly available information. Anticipated announcement don't affect the stock price. Stock prices and exchange rates are close to a random walk. If the predictions of a change in price is large, the change will be greater than the expectation. So predictions of small changes will be small. Small firm effect. Unfavourable evidence: small firms have abnormally high returns, which you wouldn't expect. A January effect: there tends to be higher returns in January. Markets can overreact. New information is not always instantaneously incorporated into stock prices. So, efficient market hypothesis is a reasonable starting price, but it needs to be adapted to make a proper theory of stock market. Recommendations from investment advisors: the implications can't help us outperform the market. A hot tip is probably information already contained in the price of the stock and is therefore not worth anything. Stock prices respond to announcements only when the information is new and unexpected. A buy and hold strategy, therefore, is the most sensible strategy for the small investor. There's been a lot more research in behavioural finance to try and explain stock market behaviour, trying to show the lack of short selling causing overpriced stocks may be explained by loss aversion. There should be more short selling than there is, and large trading volumes may be explained by investor overconfidence, and stock market bubbles may be explained by overconfidence and social contagion. But this is a very, very big subject and needs a lot more research and looking at it in your own right.